Hi everyone, let's do chapter 20, which is cost volume profit analysis, which is a fancy name for break even. And we'll talk about this. It's exceedingly important. I mean, how many widgets do I need to sell to be able to break even? You need to at least break even. I mean, the goal is not to break even. Obviously, the goal is to make a profit, but at least you need to know so you can sleep at night. How many do I have to sell to be able to at least break even? And this is an extremely important chapter. I mean, it applies to nonprofits, it applies to for profits, it applies to governments, it applies to all. Just think about nonprofits. How many donations, how much money and donations do you need to be able to have a Thanksgiving turkey for the poor? I mean, how many hamburgers do I need to sell at McDonald's so I can have a $10,000 profit for the day? I mean, these are pertinent questions that one must ask yourselves. And in business, and even if for small businesses and large businesses, they all use this. And we're going to show you examples throughout this chapter on the various applications of this. Now, again, cost volume profit means just that. It's a break-even analysis. How costs and profits behave in changes to the level of business activity. If I sell more or sell less, if I reduce my price, if I decide to have a higher fixed cost, all of these things we're going to be discussing. It's essential in developing plans and budgets. And an interesting thing, as I mentioned in the key point, is that it could be applied to a company-wide, it could be applied to a segment, it could be applied to a particular product, it could be anything. I mean, how many passengers must this air, how many passengers do I need to break even before I take this, before United Airways will launch this flight? I mean, all these questions are needed to be answered. So it's very important from the micro to the macro. And we'll go into all of these things. Now, these are, like I said to you, here are some of the questions that you might pose. What level of sales must be reached to cover all expenses to break even? How many units of a product must be sold to earn a profit? What will be the effect of changing salespeople's commission from fixed monthly salaries to commission of 10% on sales? If we increase our spending on advertising to 100,000, what increase in sales volume will be required to maintain our current level of income from operations? I mean, the world of questions, the questions we can ask. And what makes this thing so powerful is, believe it or not, the model is not very complex at all. It's pretty straightforward, the model. But because the model is very straightforward and not very complex, there's a lot of limiting assumptions that you must consider before you're able to do this. But in general, this is a real powerful model and it answers so many questions. But to be able to use the break-even model, you need to understand about certain types of costs, which I'll now be going over. The first type of cost is something called fixed costs. Fixed costs are those that do not change over an activity base. For example, McKinley's depreciation expense is an example of a fixed cost, as the monthly depreciation expense does not vary with the number of passenger miles flown. In other words, a fixed cost doesn't change. I mean, it stays the same. I'm paying rent, I pay, $1,000 a month rent, and that stays the same. No matter how many times I go to my office, it's fixed. It doesn't change unless I expand beyond this, what we call a relevant range. But in general, though, it doesn't expand at all. It stays the same, no matter how much activity I use, which is the complete opposite of the other cost, variable cost. Now, variable cost per unit, it stays the same. It could be $3 per unit or $10 per unit. However, it will increase or decrease depending upon the activity level. In other words, for every, let's just take a look at this. They talk about fuel as an example. The more miles I use, the higher my variable cost will be, obviously. But think about this. If I go to one event, it may cost me $10. If I go to two events, it may cost me $20. If I go to three events, it may cost me $30. In other words, the more I use, the more the cost is. And it's the same thing for revenues. The more I sell, if I sell something for $5, if I sold one item, it's $5. If I sold two items, it's $10, and so forth. But the bottom line is the amount per unit stays the same. The amount per unit stays the same. And I keep emphasizing that. Because if it doesn't, then we're dealing with something else called a semi-variable cost, which I'm going to explain in a little bit. But generally, we have two types. We have a fixed cost, as I mentioned earlier, which stays the same. The amount stays the same no matter what, as long as you're within this rent. So it doesn't matter how many times I go to my office, it will stay the same, 1,000 a month. Variable cost, it will fluctuate depending upon usage. So the more I use particular something or the more I produce, if it costs me $5 to make a particular product, if I make 2 products, it's $10. If I make 3 products, it's $15. We all know what these terms are. But now we're trying to define it in the sense that the break-even model requires you to know what is the fixed cost, what is variable cost. But then we get a little bit of a hiccup when we get into something called the semi-variable cost. Semi-variable costs are sometimes called mixed costs because it has both a fixed and a variable component. For example, when you think about like your water usage bill. Well, you got to pay a fixed rate no matter your fixed fee no matter what. You got to pay $20 a month if you use water or not. And then as you're using more water, it goes up. So it's one of those kind of situations whereby whereby there's a fixed component and there's a variable component. But the problem is with this is that semi-variable cost cannot be used for the break-even model. It cannot be used for that. So you need to be able to break up what is the variable portion of it and what is the fixed portion of it. Because otherwise, you can't use the break-even model. So for example, the monthly fee McKinney pays to the Fairbanks Airport is a good example, since it contains both a fixed base rate and a netted charge for each passenger mile flown. The fixed portion pertains to the rental of the hangar space for the aircraft, which remains constant no matter how much I use it, and the variable portion pertains to the airline's use of the passenger terminal. That's right. It's no different than what I said about the water usage example, whereby I got to pay a fixed rate no matter how much water I use, from 0 to unlimited, but then I got to pay a variable portion for the amount that I have used. So yes, so you got this type of cost as well. But it's extremely important because, like I said to you, when you're dealing with semi-variable costs, you can't use that in the model. So we have to somehow break it up into both its fixed components and its variable component. And there are several methods, as you can imagine. Here I go again with the several methods. And one of the methods I will be showing you is called the high-low method. And that will be very helpful to you in helping you to bifurcate the fixed and the variable. Now, if you take a look at the cost information for McKinley Airlines, you'll see that you have fixed costs of insurance, depreciation, salaries, and those are fixed because it doesn't matter. It will not change. Variable cost is 8 cents per passenger mile. So the more passengers you have, well, this variable cost will go up. And then you have the semi-variable cost, which is $3,000 per month for the hangar, plus 2 cents per mile per passenger mile. So now you're seeing what the semi-variable costs are, what the variable costs are, and what is the fixed cost. So by them telling you what the semi-variable costs are, it makes it very easy. Because what you will see here then is this amount will be part of the fixed cost in the equation, and the 2 cents per passenger mile will be part of the variable cost. So when you look at this kind of a model, what would it be? My fixed cost would be 3139 plus 3, it'll be 42,000 my fixed cost, and my variable cost would be 10 cents per passenger mile. So now you could do the break-even analysis. And again, for people who love to look at graphical, I'm more linear. My wife will love looking at the graphs. I know she loves looking at graphs. I tend to be, just give me the algebraic equation. That's me. But for ones who like looking at graphs, you can see fixed costs stay the same no matter what the passenger miles are. It stays the same. Whereas variable cost, the more passenger miles, the more it goes up. You see that? And then you can see the semi-variable cost, right? The semi-variable cost starts off at 0. It starts off with a fixed amount and then it increases. So here, as you can see, the fixed cost, the semi-variable, and variable cost all total up to my total cost line. So the more passenger miles I have, you notice what my costs are. So the question comes into play is, what about revenue? And that will make the decision as to whether or not I'm profitable. But at least you see your cost characteristics, which is essential to understanding whether or not you will be able to continue. If you can't break even with the revenues that you charge, then this is a good example of either you need to reduce your variable cost somehow or get out of the fixed cost and try to reduce your hangar space and to renegotiate contracts. But this is such a powerful tool, and you'll see how basic it is, but it's really a very powerful tool. And you can see here, and they show you what we call something called sensitivity analysis or what if analysis. You can see why this is such a powerful approach because you could have all these hypotheticals. What happens if I have 200,000 miles or 300,000? What would be my cost? And you could see the relationship of the cost. And you'll see that as you have more passenger miles, the cost per passenger mile goes down. Have you noticed that? Because why? Because the fixed portion stays the same all the time. So, that's the whole idea. Now you begin to see this. Once I cover my fixed cost, like the expression goes, once I cover my fixed cost, all the rest is gravy. That's the expression we always like to say. So if you have a low fixed cost, hey, you could make a lot of money because what's basically happening is you will accelerate your profit. As you can see, from 200,000 miles, my cost per passenger miles is 31 cents per mile. But I get to 400,000, it's down to 20 cents. This is what we mean by economies of scale, right? So the more I can get people in there, hey, it's worth it. How do you think cruise lines operate? What do you think? And you'll learn about this a little bit later on in the chapter on incremental cost. But hey, it works the same way. Hey, to them, once they got their fixed costs covered, once all their fixed costs are covered, they can say, hey, just bring the people on. It doesn't matter because we know they're gonna buy tours. We know they're going to drink. They know they're going to gamble. Hey, once our costs are there, pretty much bring them on for free. That's going to cost us much. Once our fixed costs are taken care of, it's worth them to bring it on because it's not going to cost a whole lot. But this is extremely important that you need to make sure you have it down to understanding. And I mentioned this thing as we're going along, but just understand again. You notice per unit, variable cost stayed the same. Variable cost stayed the same. And the reason why is that it's always going to be $5 per unit cost, $6, or in this case, 10 cents per passenger mile. It's always going to stay at 10 cents. Now, fixed cost in total stays the same. You see, in total, it stays the same. But think about it. If this is what I call the make you feel good scenario. Now let's just say I pay rent of $1,000 a month. It stays the same if I use it or I don't use it. But if I go in one time, it feels like it's costing me $1,000 to go to my office. If I go to my office 2 times a month, well, it cuts it down to $500 per use. And if I go 10 times, it makes it $100 per visit. So you notice, so fixed cost, as I keep going in and as I'm using it, fixed cost per unit goes down, but the amount stays the same in total. It just makes you feel good. Make sure you read, and we'll show you this example of that. But remember, it's what I call make you feel good. It's the make you feel good concept in the sense that, hey, I'm going to pay $1,000 no matter what. But the more times I go into the office, it makes me feel good. Just think about when you buy a Disney pass, an annual pass, and it may cost you $400 or whatever for a family, for $500. Well, if you only go there one time for a vacation, hey, it's cost me $500 for this one vacation period. Whereas if I go there 2 times, fall and spring, hey, maybe its average is $250 per visit, and so forth. But it still cost me $500. So, like I said, the total cost for fixed cost stays the same, but the fixed cost per more as I'm using it decreases. So make sure you understand that concept. And you'll see it here with the concept of economies of scale. Economies of scale refers to the reduction in unit cost by using the company's productive assets more efficiently. To illustrate, assume that the automobile plant incurs fixed costs of $8.4 million per month and has a capacity to produce 7,000 cars per month. Well, my fixed cost is going to stay the same. I mean, like I said to you, it's like going to my office. I'm still going to pay $1,000 every month. But the more I produce, the fixed cost per unit decreases. Per unit it decreases. The amount stays the same in total, but the amount per unit decreases. Think of the Disney example I gave you. Think of my office example. It's the same thing. But don't fool yourself. It's still $88.4 million a month. So, economies of scale are most apparent in businesses with high fixed costs, such as airlines, steel mills, utilities. Just keep that in mind. And you can see, you're going to have all these different types of cost behaviors. And one of the things that you'll learn is, you know, like with fixed costs, I keep saying fixed cost stays the same in total. That is true. However, if you go beyond a certain activity level, it may have to increase. For example, you know, let's just say, and I'm talking about the stepping model here. What I'm saying is, let's just think about this. My classroom could hold 40 people. So it's a regular sized classroom and you have 40 students coming in. But if I got that 41st student showing up, I may need a bigger classroom. And therefore my fixed cost will increase because I need a bigger space. Because what that is defined as what we call relevant cost. It's my relevant cost. What I mean by that is that fixed costs stay the same in total as long as I do not exceed my relevant range. So if I could hold up to 40, and if say I'm paying, the school is paying, let's pick an arbitrary number. The school is paying $2,000 a month for that one particular classroom. Okay, it could hold 40. So as long as you keep it up to 40 people, it's 2,000 a month. But if I have that 41st student showing up, I need a bigger space. And therefore I may have to have a bigger classroom, which might cost me 3,000 per month. That's what we mean. It stays the same within a relevant range. And like here, it may be up to 2,000 here, but the minute I have that 41st student, it may go up. Just keep that in mind. And that's called the relevant range. Taking, all the possible variations of cost behavior into account will add greatly to the complexity of cost volume. So what we try to do in general, without going into all of this stuff, is that we got to break these things down into what is my variable, what's my fixed. Because otherwise, if we're going to get into patterns like this, where we get into marginal costing, this is economics scales. It's going to be very complex. So what we try to do is we try to keep these things, understandable and managed, in terms of the cost we have. Because really in economics, there's a whole lot more than fixed and variable and semi-variable. There's a lot of different types, like what happens if most of the costs are upfronted and then it decreases later on. I mean, there's a lot of different cost patterns, but for the break-even models, we try to keep it into fixed and variable costs only. So now we're going to get into the models that we use to do break even. And again, this is, as we could imagine, how do you calculate my profit or operating income? It's my revenue minus my variable cost minus fixed cost equal operating income. And as you learn in management accounting in this course, there's so many ways we can classify costs. Direct materials, direct labor, production costs, period costs. I mean, there's so many ways we could label costs. But for us, for this particular chapter, we're going to be always discussing break even in terms of variable and fixed because this is the model that we use. This basic relationship sets the stage for introducing cost volume profit analysis. And like I said, it's often called break even because exactly what we're trying to do is determine what the break even point is. And basically, the break even may be defined as the level of activity at which the operating income equals to zero. So you always like to know that, even though you're not in the goal, your business is not for the purposes of breaking even. But boy, let me tell you, you like to know that. That's what you sleep at night with. Oh boy, I need to hit at least 10,000 to break even. Oh, I super, 10,000 units I need to sell, and you know that you just sold 10,000 units in the second week of the month, you could sleep. That's why it's so important to understand what break even is. So let's take a look at some of the points. The term profit and cost volume profit refers to operating income, not net income. Once again, we're dealing with the operations once again. This is because income taxes and non-operating gains do not possess the characteristics of fixed or variable cost. They're one-time items. They don't really represent that. Cost volume profit analysis conveys very little information about cash flow. It has nothing to do with cash flows. So, for example, revenue often results from both cash and credit sales, whereas expenses often result from both cash payments and charges made on account. So remember, break even has nothing to do about cash flows, and it's only dealing with operating income, not net income. It has nothing to do with taxes and so forth. So keep that in mind as well. So let's take a look then at this particular operating information. So you can see here, what the average selling price per board. You see what the variable expenses per board is, 36 bucks. Very important term now, the contribution margin. Do not confuse this with profit margin. Do not confuse this with gross profit or gross margin. This is different. This deals with the concept of selling price minus variable cost is what we call a contribution margin. This is not gross margin. Sometimes people get confused because remember, gross margin would include both fixed and variable. This only includes variable. Then you get your fixed cost, and then you see what my total fixed costs are. And if you're looking at it from terms of percentage of sales, instead of calling this a contribution margin, you will call this a contribution margin ratio. So make sure we understand the terms, because as you're going to see, the formula for break even is simply fixed costs over selling price minus variable cost. And that's all it is. That's what I'm saying. We have to break it down by fixed costs and variable cost per unit and selling price per unit. That's all we need. That's what I'm saying. It's such a powerful tool. And you can see here where the break even point is. You can see this is where it is. And after that, everything is gravy. But this is the break even. This is the break even point. And you can see the break even will be somewhere around 700 units. Will be somewhere around 700 units. So you can see it's such a powerful tool to try to calculate. It's so powerful. So for example, how do we get that 700? Formula-wise, it'd be 37,800 over 90 minus 54, and that will give you 700 units. So again, we'll show more examples of that, but it's such a powerful tool to do that. And you can see here the contribution margin, so we understand the terms, is revenue minus variable cost. So remember that. And contribution margin per unit is unit selling price minus variable cost per unit. This is what we use for the break-even formula. And the contribution margin ratio is the contribution margin per unit divided by unit sales price. But it is, again, it's a very straightforward, and you really need only three things. What is my revenue per unit? What is my variable cost per unit? And what is my total fixed cost? If you have those three features, you can do break even. So here, for example, as we were just showing you in this particular example where we were showing you, what it all comes down to. Here's my $54 contribution margin, and because my variable cost is 36 and my selling price is 90, as you see there, here's a graphical diagram of that. You can see my unit contribution margin is 54. My unit selling price is 90, and 36 cents is my variable cost per unit. So you can see that, and it's such a powerful tool. Like I said, it's simple. It's what we call simple elegance, that it accomplishes a whole lot with very little information which is needed. So it's, again, I don't mean to be overemphasizing this, but it's such an important tool. You'll appreciate that in your own business when you're looking at this. So how many units must we sell? Well, the concept of contribution margin provides a quick means of determining the unit sales volume required for a business to break even. Knowing the break-even sales can be of vital importance, especially the companies deciding whether to introduce a new product line, build a new plant, or remain in business. Hey, if I can't break even, hey, forget it. If I can't sell enough products to break even, then I shouldn't be in that business. It's an extremely important concept that you need to take a look at. So let's take a look at it, for example. Now, I just showed you how we got 700 units. But let's repeat. It is fixed cost over sales price per unit minus variable cost, and that gives me 700 per unit. That's it. It's as simple as that. And that is why we need to break everything down into variable cost and fixed cost. Now, but like I said to you, you're not in the business to break even. You want to make some money. So the formula is very easy. So just like this, you have the fixed cost over contribution margin per unit. Only thing you need to do is add my operating income. How much profit do I want to make? So for example, how many snowboards must Snowglide sell to earn a monthly operating income of 5,400? Well, just add 5,400 to the break-even model, and therefore instead of breaking even at 700 units, if I want to make a profit of 5,400, I have to sell 800 units. Now you see how simple, elegant this is. It's a very basic model, and it works in so many different ways. So, but now the next question comes into play is, well, how many dollars in sales must we generate? Now, the book does it this way. It's fixed cost plus target operating income over not the contribution margin per unit, but it's the contribution margin ratio, which is 60%. And they take the 37.8 plus the 5,400, but instead of having it per unit number, you got a percentage, which is a contribution margin ratio, which is $72,000 per month. But let's think about it. There's another way of doing it, which I tend to use. What I do is I tend to go back and figure out how much does it cost me the selling price per unit. The selling price is what? $90 per unit. What I tend to do, and you are welcome to use either method, it makes no difference. What I tend to do is know what my break even is in units, 800, and I multiply this by selling price per unit, which is $90, and that gets me my 72,000. So the way I do it is I tend to calculate what is my break even in units, then multiply by the selling price per unit to come up with the sales dollars. They do it by taking it and by using the contribution margin ratio. It doesn't matter. Whichever way you feel more comfortable in doing, as long as you get the right answer, it is fine. It doesn't matter. And like I said to you, how powerful this kind of concept is because you could change all the facts and do what if, what we call sensitivity analysis. It's an excellent tool. So let's just say you're still going to keep the selling price at $90 per unit. The $1.80 overtime premium will reduce the contribution margin from $54 to $52.20 because now what they're saying is we're going to change the variable cost from 36 dollars. We're going to add another $1.80 to it. So now my contribution margin is $52.20. So say I want a profit of $36,300. So how much is this thing going to affect me? And also I'm also going to, the director of advertising sees a monthly increase of $1,500 in her budget. So what they do is then change the model. Not the model, the factors that go into the model. And they say, well, I want a $36,300, income. My new variable cost now is 52.20. What it is my contribution margin now is 52.20. And the thing is, and we know my fixed cost, then my fixed cost is now 39.3. So what do I get? Now, under these conditions, I need to sell what? 1,448 units per month if I want to meet this criteria. But you see how powerful it is? You could change the fixed cost. You could change what I want. You change your contribution margin. You could do all these what ifs. And then at the end of the day, you're going to come up with what the new break even is. What do you think airlines do with their passenger seating? Oh boy, we have some extra seats available. We could lower the price because we already hit the pricing. It's a terrific model. So the vice president here says, I isn't convinced that an increase in the monthly advertising budget or fixed cost of 15 will yield sales of 500 more. Assume that the monthly advertising budget is now increased by 1,500 and the direct labor costs actually do increase by $1.80. If the vice president of sales is correct regarding her 1250 unit projection, she wants to know the extent to which the company will have to raise its selling price. So you see, you could change anything that you really want to do. That's what makes this a wonderful model. So how do you go about doing that scenario? Well, you change this, anything you want to do. You could change now the selling price, right? So again, you could do anything you want, and if you do the calculations, the selling price now is 60.48, and now all of a sudden you can see what it all turned out to be. You need now to come up with, given the required contribution of 60.48, we can easily sell for the required unit selling price. Therefore, we need to get to $98.28, pure algebra. So you can see all the various applications one can do while doing this concept of the break even. Now, in practice, break even analysis is often complicated by various operating factors. What happens if you have more than one product that has different contribution margins? You need to determine semi-variable costs. And also, you got to comply with the assumptions. So, like I said, because it's simple, there's a lot of limitations that we have to deal with. So you need to work it out. Like I said, for one of the things, if you have a semi-variable cost, we have to break it out into fixed and variable. So that we could overcome these things. But the main thing for you to understand is to recognize what they are. So when a company has many different products, which is most companies, and they're going to have different contribution margins. So the sales mix describes the relative percentages of total sales provided by different products. Different products usually have different contribution margin ratios. And managers often what they do is come up with an overall average contribution margin. It may not be the most precise, but at least it gets you in the ballpark. All right, so for example, if you have more than one product, and like they show you here with Snow Glide sells, in addition to snowboards, they sell goggles. So contribution margins for the two products are 60%, for snowboards and 80% for goggles. And if you see how they do it, so therefore the average contribution margin ratio is 62%. So you could use that as well. But I mean, again, as you more advanced techniques can be used, obviously. But just to give you an idea, that's how it's done. But what happens, more importantly, what happens if you have semi-variable costs? So remember, if you have that, you need to be able to break it out. And one of the methods that you can do is there's regression methods, but the one we're going to just focus on is called the high-low method, because this is because as the name implies, high-low, you're taking an average. That's all you're doing, and that's what they're applying. So let's take a look at how this is done. It's pretty straightforward, but again, just to be comfortable with it. Assume that some portion of Snow Glide's total administrative cost is fixed and some portion varies with the level of production, so it's semi-variable. Information pertaining to production and administrative costs for the 6 months are shown below. Now you notice that you have all the total units produced, and the thing is they have different amounts. If they were exactly the same, for example, if they were exactly the same, they will be, if they were like $2 per unit, or you will notice this would be 1800, this would be 1700, this would be 1900. They will be exactly the same. But you notice if you divide these numbers, you're going to come up with different averages because there's a fixed component. Because remember, what's the definition of variable cost? Variable cost means it's the same per unit. So if you go to the first one in January and you divide 25060, if you divide 25060 by 900, it comes out to be $27.84. $27.84. So if this is variable, this also should be $27.84. So let's take a look. This is 25040 divided by 850, and that's 29.45. And it will be the same for all of them. They're not exactly the same. If it's the variable, it has to be a variable cost, it has to be the same per unit. These are not. So therefore, there must be some fixed component and there must be some semi-variable. There must be some variable in there. So let's continue on. To find the variable portion of the total administrative cost, we relate the change to the cost and the change in the activity base. It goes first by the activity base between the highest and the lowest months of production activity. So the highest activity was in April with 950. And the lowest, because again, we're taking the average of 850, therefore it's 100. And we take the administrative cost and we decide that the difference between these two is $2.40 per unit. And that's the variable cost. So you divide the 240 by 100 and you know that my variable cost per unit now is $2.40. And it's basically an average because what you're doing is taking the highest and you're taking the lowest. That's what's called the high-low method. So now you know that my variable cost portion is $2.40. So now, with that being said, let's see how we apply this then. Well, we know you could either take the highest one or you could take the lowest one. It doesn't matter. You could take this one or you could start with this one. It doesn't matter. Once you know what it is per unit, it doesn't make a difference. So here, to determine the fixed portion, we can take the total monthly cost at either the high point or the low point and deduct the variable administrative cost from that amount. So what you do is, in this particular case, they took the what? 25,280. They took the highest one. You could have done it with this as well, but they're starting off with taking 25,280 minus the $2.40 per unit, which we calculated, times the activity level of 950, and they come up with 23,000 per month. And if you would have done it with the low method, it would have come out to be the exact same thing. So now you know what the formula is. So now with this kind of item, you would say $23,000 will be allocated to my fixed cost. $2.40 will be part of my variable cost, and that's all you do. So now we have developed the cost formula for monthly administrative costs. It's $23,000 plus $2 per unit. In addition to helping the company evaluate the reasonableness of this formula is also valuable in forecasting administrative costs in the future. I mean, we want to know, based upon how much output we're going to have, what's going to be our cost. So, for example, what amount of administrative cost should Snow Glide expect in a month with that scheduled 930 units of production? Well, you know it's going to still be 23,000, but now you're going to multiply the $2.40 by the 930, and therefore we can estimate that it's going to be 25,232. Again, very straightforward and so forth. And last thing is, what kind of assumptions do we have to comply with to use the break-even analysis? Like anything else, you need to have some limitations. We assume that the sales price will stay constant. If more than one product is sold, the proportion of the various products sold, the sales mix will be the same. Fixed costs are assumed to remain constant at all levels of sale within a relevant range. Remember I told you that earlier, that 41st student, right? Variable costs are assumed to remain constant at a percentage sales revenue. And for manufacturing companies, the number of units produced is assumed to equal the number of units sold each period. These are some of the underlying assumptions when you're doing a break-even analysis. Now, again, here are some basic formulas that you should come and understand. I didn't do the margin of safety, but generally the rest of these things, you should make sure you understand them and feel comfortable working with them. So anyways, make sure you read the chapter for great details. Make sure you do the practice problems. And again, if you need more practice problems, please reach out to my TA, Lakey, or whoever my TA will be at a particular time. But right now, just make sure you reach out to my TA. And take care.